If you look at the last few years, the story of NVIDIA felt like a rocket ship, parabolic, unreal. But if you're watching the tape in July 2026, you've noticed something different. The vertical climb has stalled. We aren't seeing the explosive triple-digit surges of 2023 or 2024. Instead, we're seeing something called the digestion phase. First, let's address the elephant in the room. Why is the stock trading sideways? It's simple. Expectations have caught up to reality. Throughout 2026, we've seen a rotation. Growth investors who rode the AI wave are looking for new sectors, and the hype premium has been stripped out of the share price. Interestingly, as of mid-2026, NVIDIA's price-to-earnings ratio is the lowest it's been in 7 years. Think about that. The company is objectively more efficient, more profitable, and more essential to global infrastructure than it was when it was trading at a massive valuation premium. The market is currently pricing in a scenario where AI growth moderates from its peak. But here's the counterargument. The absolute earnings power of this company is growing, not shrinking. We're looking at an $81.6 billion record revenue quarter back in May. That's not a business in decline. That's a business scaling into a new operational reality. NVIDIA isn't just selling chips anymore. If you still think of them as a GPU company, you're missing the shift. In 2026, they are the default systems vendor for the most capital-intensive phase of global AI deployment. The strategy has moved to the full stack. We are talking about networking, CPU offerings, and optical interconnects that stitch massive GPU clusters together. They've successfully moved into every layer of the value chain. And let's talk about the hardware moat. The recent push toward Vera Rubin and the absolute dominance of the Blackwell architecture isn't just about raw compute. It's about energy efficiency. June 2026 brought a massive breakthrough. 45 degrees Celsius liquid cooling. They've eliminated fans entirely in some designs. Why does this matter? Because power is the single difficulties in AI. By making these factories 100% liquid cooled, NVIDIA isn't just selling hardware, they are solving the physical infrastructure problem for the entire industry. That is a sticky enterprise-grade moat that competitors, like AMD or custom cloud silicon, are still struggling to replicate. Here's where the free option inside the stock comes in. Everyone is watching the data center segment, but while that's happening, Jensen Huang has been quietly building two other massive pillars, robotics and automotive. The platform is called Isaac for robotics and Drive for autonomy. In 2026, we are seeing the transition from generative AI that talks to agentic AI that does. This is the era of physical AI. Whether it's robots in manufacturing, logistics, or healthcare, these machines need to perceive, think, and act in the real world. That requires a completely different type of compute, and NVIDIA is already the underlying operating system for these agents. The market hasn't fully priced in the revenue contribution from these divisions yet. They are currently the free bonus in the stock. But as these agents move from concept to full-scale deployment in factories around the world, expect these numbers to become a core part of the earnings call narrative. Now let's be balanced. It wouldn't be a deep dive without acknowledging the risks. The French antitrust investigation, which thankfully closed recently, was a wake-up call for investors that regulatory pressure is a real threat in Europe. Then there's the CapEx fatigue fear. Can hyperscalers, Google, Microsoft, Amazon, keep spending billions on AI infrastructure if the ROI doesn't materialize fast enough? If those companies slow down their data center builds, NVIDIA feels it first. However, the data suggests that we are nowhere near the overbuilt stage. The move by the Nebius Group, or the massive cloud investments in South Korea and the UK, shows that this isn't just a US phenomenon. It's a global arms race. The barrier to entry for a custom chip is high, but the barrier to entry for the software ecosystem, CUDA, is even higher. Even if rivals chip away at market share, NVIDIA is becoming the standard for AI everywhere. So, where does this leave us in the summer of 2026? We are likely in the middle of a massive digestion cycle. The stock isn't going to move on hype anymore. From here on out, it moves on execution. We have clear visibility on Blackwell and Vera Rubin. We have the pivot to agentic AI, physical robotics, and a cooling revolution that makes current data centers look like ancient history. The thesis is no longer about whether AI is a fad. That question has been answered. The thesis is about whether NVIDIA can capture the value of the AI factory as it moves from the cloud to the edge of the physical world. If you're a long-term investor, the sideways action of 2026 might be the most boring part of a very exciting story. Keep your eyes on the margins, the shift to liquid cooling, and the adoption of Isaac Robotics. The rocket ship didn't crash, it just hit its first stage separation. I'm interested to see where it goes from here. Thanks for watching, and stay curious.